So the next section of the presentation is a very interesting one that should always be at the top of mind for decision makers in a medical practice, because we live in a very, very interesting time with regard to the cycle of medical malpractice insurance. It's critical to understand that while all insurance is cyclical and stock market is cyclical, as we're seeing now, the MPL industry, medical professional liability, is hyper cyclical, and the ebbs and flows are severe. There's a number of factors to that, and there's concepts, and we're going to try to touch on a few of them. One thing to keep in mind as we're talking through this is there's a significant delay in understanding your performance as an insurance company due to the long tail nature of claims. There's no better example than New York City or Cook County in the litigious nature of society, but also the delay in a claim coming to resolution. The patient may be seen in 2020, and the lawsuit may not be filed for a year, two, or longer, and then it sits in the court system for any number of years, notwithstanding this delay that COVID-19 has caused on the system. So it's very difficult in defense of the insurance marketplace to figure out how much premium should be collected, given that we don't know exactly what the claim activity will be or the outcome of those claims. Consider it against a homeowner's policy where you have a tree fall in your garage. The tree falls in your garage on Tuesday. You know who the carrier is, you know the date, you know the coverage, and the carrier knows the date, the coverage, and the damage. Diametrically opposite in the medical professional liability space, hence a bit of uncertainty as we look at financials and we look back. And unfortunately, it gives carriers the ability to, at times, undercharge for premiums when, and somewhat get away with it because those dollars that they should have collected or do collect don't need to be paid out for sometimes several years. So let's get into some financials, some numbers. Premium volume, incredibly important. It is just a big, bulky number, but it has to do with everything at an insurance company. It has to do with giving dividends or reinvesting into the physicians, the policyholders. It has to do with reinvesting into risk management. It has to do with investment income on their own balance sheet, right? So an insurance company may collect $1 and pay out 90 cents on that dollar in claims and losses, which we'll get into later. And so 10 cents of that dollar goes into the stock market, the bond market, some sort of an investment vehicle, and earns money before it needs to turn into a payment of a claim, if that's the trend in the business. So investment income is driven in large part by premium volume. As an aside, we will see how these companies perform financially on their investments. You know, I guess Chubb has a good amount of junk bonds, and that's not going to serve them well on the financial end. But the med-mal carriers traditionally are in bonds, medium to short duration, so hopefully they were in A-rated bonds, treasury bonds, and they'll perform okay. But premium volume, to stay with it, at the peak in 2007 was right around $12 billion in the market. So 12 billion, 2007. The trough, probably around 2017, at least for this cycle, and that's at $9.5 billion. So the market is down in premium 25%. We've actually ticked up since 2017, not close to 12 billion, but we've ticked up and we're off the bottom of the cycle. And why did premiums go down so precipitously? Well, two main reasons if we were to assess it. Number one is the consolidation in healthcare between hospital systems and hospital systems, physicians and physicians, and then physicians into hospital systems. Physician consolidation has slowed. The velocity of that consolidation is not what it was previous, and I think, in fact, COVID-19 could bolster the emergence of more private practices and more physicians out of these large institutions, whether they're private equity backed or hospitals. Yet to be seen, of course. But the other factor that drove the premiums down was the rate decreases. So premiums for a physician practice in 2007 may have been $100,000. By the end of that 10-year cycle, they might have been $60,000. So collecting less dollar amount, less premium per account certainly ate into the gross premium of the industry. Let's talk a little bit about claims as they impact the financial performance for sure. There's claim activity, which is just the raw number of claims in the system, and then there's the severity of claims, which is the payouts per claim. And then there's the term which has been hot for about a year and a half, 2 years, which is frequency of severity, which is the number of severe payouts, the number of shock payouts in the system. If we were to use $10 million as sort of that baseline of what a large payout is, they've increased precipitously over the last, call it 5 years. As far back as the mid 2000, 2010, 2015, they were in the single digits to the 20s, $10 million payouts or more annually. 2016 there were 30, 2017 40, 2018 45 plus, and maybe that continues, maybe it flattens out, but that's a lot, and that hits the system. Our friends at Transatlantic Re put out that data. Very thankful for their good information, and also Conning, an industry leader in all of this analysis. They do a fantastic job. But so $10 million payouts doubling over a 5 to 10 year period is significant. And those verdicts are a result of a few things. There's no real science behind it, but I think consolidation and things being wrapped into bigger insurance programs, deeper pockets, has something to do with it. We can also point to wage inflation. So a factor into what dollar amount is awarded in an indemnity payment is driven by cost of care and for the future, cost of care for the past, and wages. Both up significantly, cost of care through technology and just the ability to keep people healthy, alive. There's more drug costs than ever. And there's a third concept called social inflation, which is more sentiment based, and it's a hot phrase right now. But people, whether it's boards that govern sort of rules around litigation or payouts, or there's jury sentiment, the ages of populations has an impact here. But the easy way to explain it, or give an example of why social inflation has crept into society and impacted this business, is because athletes might sign a $300 million deal, or the Kardashians are flaunting around in their via social media in their private jets, and I think there's a numbness to large numbers. So cost of care, wage increases, cost of drugs, and this concept of social inflation, all three have combined and along with other factors, driven these severe payouts, which has hurt the industry. And the theme of this whole slide is essentially premiums are going upward, and here are factors. Underwriting appetite through the last decade up until 2017-18 was very aggressive. Top line growth was the focus, and now we've seen a sea change to a profitability focus. Right? We're not going to chase business. When a renewal comes through, we're going to try to get the premium increase we're asking for. On new business, an underwriter might not give the best price, to give the price they used to give. Now it's more a focus on how much do we think this is going to cost us, and we need to charge a bit more to be profitable. If we can, let's go into some ratios which measure the financial health of a carrier or an industry. One thing to understand is accident year versus calendar year performance. Accident year performance looks at kind of a snapshot in the moment, what the accident year looked like and how much money was set aside for claims, in the given year. Calendar year looks back and it has adjustments. This claim didn't pay out, so we can reduce the reserve on it. This claim closed with no payment, we can pull back money. This claim looks like it's getting worse, we need to fund reserves. So that's the give and take based upon the long tail nature of the business. But if we look at loss ratios, which is claims paid and the expenses to pay them, and expense ratios, which is keeping the lights on, they've both ticked up. Loss ratios, have been in the 30s, let's say, from mid 2000 to 2016, and then in 2017 jumped up to the low to mid 40%. And in 2019, up to 50%. So losses have increased across the board nationally, and now they're up to 53%. So on the dollar collected, 53 cents of it is gone to losses, and that's a lot. That means that you have to keep your expenses low and your premium up to keep your combined ratio above 100, below 100%. Again, to be profitable, if that's the goal. If we looked at combined ratio, it's the chart on the left. You'll see that the dark blue line is the MPL industry, and that trend is not great. It's pushing companies to raise rates. As you see now, 107, 108% from 2019 is how the market performed. And in 2020 and 21, we're creeping up toward 110%. So that means on average, the company's losing 8-9 cents on the dollar operationally. Now, if they can make it up in investment income, or they can have the benefit of again pulling down reserves from previous years, they can mitigate those bad years. But we see that trend increasing, unless, of course, COVID-19 plays a part here, or carriers are able to get more rate than we anticipate, and therefore drive down that lack of profitability. Conning put out a couple numbers. 2018, 40% of the MPL market had a combined ratio in 2018 of 100% or more. That's 40% of the company. So 40% of the companies were operating, not the investment income, unprofitably. And in 2019, 60% of the companies were operating above 100%. All that means is they need to collect more premium to fund losses and expenses. And so what we are seeing across the board is premium increases. And how can you mitigate those? Because that's the name of the game. Mitigate increases, take advantage of decreases when the market turns. Risk management. Have you employed any risk management? There's significant resource inside the malpractice carriers. There's technology companies that provide risk management, and taking advantage of those, even if it's an investment on your end as a practice, is important. Differentiating yourself from the practice next door takes into account what your risk management measures are, who your broker is, and how you're advocating for yourself through your broker. And third, what is your market coverage? Are you going to someone, a broker or an agent that represents all of the carriers, or just one or two? And the last part of it would be, how is your carrier relationship? Have you built up a good relationship with your insurance carrier, with the broker involved, or has it been that you've jumped around to a new company each year? So those four things can help mitigate rate increases and provide price stability over time. There's other factors like the size of your group, your claim activity for sure is important, and the carrier and their financial position. A couple of things to look out for when you're analyzing companies is surplus. How is their surplus trended? Now, if they have 10 times, your surplus is typically measured as a percentage of premium. If you've got $10 million in premium and you've got $20 million in surplus, that's 2 to 1. That's very healthy. If you go from 2 to 1 to 1.9 to 1, that's still fine. Where you need to be worried is when the premium and the surplus ratios are not so clear. Companies that have less than a 1-to-1 surplus to premium are not necessarily in great financial shape. And a bad year or two, especially if they're small companies, could turn the tide, and that's when regulators come in and guarantee funds get triggered, and quite frankly, disruption in the market occurs. So it's critical for provider groups and their advisors and the brokers to monitor these surplus numbers. Other areas to look at are, what is the structure of your company? Is there a management company in the middle? How are they paying themselves? Where are those expenses going to? If they're paying a broker, we can allocate expenses there. If they're paying themselves, well, how much money are they taking out of the business? And we'd be happy to take questions offline on these things, because it's a bit complicated as you dive into specific states, specific companies, based upon specialty, risk retention group versus admitted carrier. All of these factors are important when considering the health of a company and the health your liability future.